Hi, good morning. Loads to talk about, but firstly, how much would you really read into last week's global market recovery? India as well joining the rebound.
I think it's good. It's better than I expected, despite the fact the volume is low. The breadth and the participation is good, and I think we're just on the cusp of the lower end of where people might have to start short covering. And if they do, that could take it up about another 8 to 10% over the course of when, I don't exactly know. We could rally could end tomorrow. It could go on into July. I do want to say I think it is a bear market rally, and with the exception of companies that are either inflation beneficiaries or are hedged against inflation, I would be selling into it.
Mark, in our earlier conversations as well, you've always made a very interesting point that with elevated oil prices does not mean that that's going to take India down. Now, the problem is that while agri-inflation definitely has eased off, prices of crude continue to hover around $120 to a barrel, and 120 by no means for an oil importing country like India is anything normal. But just wanted to understand, do you really sense that Indian equity markets and crude could actually have a disconnect?
Actually, at $120 a barrel, it is difficult. But I would say the pain point, which used to be at about 70 or 80, is definitely much higher. And precisely where it is, I can't say. But 120 is an issue, despite the fact that pump prices are subsidized. There's a trickle through of higher energy prices into so many other aspects of inflation, including food, because you need energy to make and distribute food, but it's not the only one. So it is an issue at $120 a barrel, but I think it is an issue for every other country in the world, with the exception of the handful that are commodity beneficiaries like Australia, Canada, South Africa, Indonesia, that kind of thing.
Of course, everybody's also watching out for cues in the US. If there is no recession, it's going to be fantastic news for the global equity markets. But back, Matthews, it's a big week that's coming up for India. Our central bank will be meeting to discuss rates. It's also another trend which we have seen. While May has been brutal for the Indian equity markets, the velocity of the sell-off by the foreign institutional investors has come down. What do you make of that? And just going by elimination, if they're not going to be in Russia, if they're not going to be in China, why aren't the foreign investors pressing the buy button for India?
Well, I think the biggest reason is that it is an emerging market, equity market, and those are perceived to be risky. And when you've got the S&P itself that is down about 13 or 14% so far this year, then it's really hard for anything to be up unless it is, an outright beneficiary of inflation. So that's why. But by the way, I just want to also add that I think with China opening up again, there is a chance it could start attracting some foreign capital. A lot of people will say, "Oh, I can't invest in China anymore because of the geopolitics," but I strongly suspect if it goes up 10%, they'll change their minds.
Matthews, is that a footnote for a warning that brace yourselves for more heavy selling by FIIs, maybe in the weeks and months to come, which had slowed down?
No, actually, I'm looking for this rally to continue, and so on that basis, India would be included. But I just want to say, don't get suckered into it because I don't think we're in the beginning of a new bull market.
Interesting. Mark, the other big worry here in India is that we've suddenly seen a spike in cases, COVID cases that is locally. Just wondering whether tactically right now one should stay away from the entire hotel, hospitality, aviation kind of pockets and maybe be a little bit more skewed or tilted towards, say, pathology names or hospital stocks.
Well, there have been upticks in other countries too, and I haven't observed that's really changed mobility patterns. Then the mobility patterns probably will not change unless there are lockdowns, which you would know better than I, but I doubt that they're going to do that in India. So, I mean, clearly, if there's a major COVID resurgence, there will be some people who will change their minds. But I think the majority probably, I've already got COVID and they've been vaccinated and they just want to get on with things. And so I don't think it would be a major retardant for the economy.
Makes sense. Yeah, definitely lockdown's not happening here or I guess anywhere else other than China. But Mark, when it comes to India, what are the other spaces that you're looking at? Anything new after the recent correction that attracts or catches your eye?
I apologize. In all honesty, I have not been looking at the market in enough depth to see the kind of thing that you would like me to answer. I better just skip the question. I apologize.
No worries about that. I think you made it pretty clear that we should watch out for China reopening, foreign funds re-looking at China, and that you think the rally is intact with a special focus on whether the U.S. enters recession or not. But Mark Matthews, given all of this, and given that we're talking about a week where we may see rate hikes, including in India, the European Union is also slated to have a lot of important meetings. Tell us, what are you folks talking to your clients about when it comes to staying invested in the equity markets? There has been analysis which has come out which shows that cash is actually outstripping what we saw in the great financial crisis, and cash holdings are what they used to be post 9/11.
Well, I'll give you an interesting statistic. If you had $100,000 today, and we have an inflation rate that is running at about 7% per year, by the end of this, in 10 years' time, that would be worth $63,000. So keeping it in cash, I don't think it's a very good, viable long-term option. I think we should be invested in proxies for real assets or the real assets themselves. And those are the things you can touch with your own two hands, like commodities, like real estate. The proxies for them are the companies that produce them, and there are some that are listed on the exchange. And I think that is the place to be invested, not entirely, but certainly have a healthy exposure to it. We've chosen Canada as our main way to do that, but there's lots of other places in the world you could do the same.
Where are you when it comes to this entire debate about growth stocks versus value stocks? Back home in India, if you were to see the top 50, the Nifty 50 is the value stocks which have been outperforming. In the US, the tech stocks, which are clearly oversold, are making to come back. We started to see some signs of that when it comes to fintech, for example, back home. Do you think the tech stocks, the new age companies, are going to stage that comeback? Because it's also the easy money era which is coming to a close.
I think that right now we know we're not in the same market we were a year ago or 2 years ago. The great bull market that lasted from the end of the global financial crisis really up until November, December of last year has ended. And exactly what is in front of us, we don't know. Eventually, the cyclical bear market that we think is what we've got presently will end, and we'll go back into a new upcycle. But I don't think anybody really knows what the leaders will be. I don't think the large technology stocks will be the leaders simply because they are too large. So to grow when you're already that size is difficult. I think they can perform perfectly well in line with the market. They won't be the leaders. I would say one sector we've identified as being a potential leader is the pharmaceutical sector, where the major cost component for those companies is research and development, not raw materials. And so Yes, they do have some raw material prices that are going up, but it's not going to suppress their margins very much. And we've noticed that after 5 years of underperformance, the pharmaceutical companies are now outperforming the broader market in the United States and Europe.
Sure. Okay, Mark Matthews, great to have you on the show today. Thank you so much for taking the time out and speaking with us.